Welcome to Street Talk, S&P Global Market Intelligence podcast that offers listeners a deep dive into issues facing financial institutions and the investment community. I'm Nathan Stovall, and on this episode, we're talking about banks' third quarter earnings season and what results tell us about the health of the consumer, the economy, and bank profitability, and how fundamentals could influence bank strategies going forward. Joining me on the show to dig into all of this is Chris Nichols, Director of Capital Markets at SouthState. Chris, thanks for being here.
Nathan, thanks for having me on. I've been wanting to do this for a while, do an earnings recap with you. You have your finger on the pulse of data there at S&P Global, and I got a lot of opinions. So I've been looking to get some of those out and bounce some ideas off you to figure out like what's your take on the economy. So this is basically a recording of a normal conversation we would have every quarter. You say the economy, and normally I glaze that over like, yeah, banks are just a major part of the economy. But I think this quarter, one of the hallmarks is without government data. Like I'm just looking for different sources. Like I'm asking Uber drivers, I'm asking flight attendants, how full their flights are. I'm trying to get data from anywhere I can, even if it's anecdotal. And I think bank earnings provide one of the better sources of indicators in the economy. So happy to have this conversation.
Sure. In the search for alternative data to get our finger on the pulse of the economy, we can go back to the original thermometers of the
That's right.
economy, our friends in banking. So let's start with the consumer and what you feel like we've heard from banks. It's a little striking to me because, as you mentioned, we don't have a lot of data out there. We've had a couple of weak employment prints. You keep hearing questions about the consumer being out of gas, but I feel like everybody kind of said consumer's resilient, spending still up. Some acknowledgement maybe of K-shaped recovery being part of that, lower income segments, and certainly, and I know we're going to talk about credit too. The stress that we have seen in credit seems to be in more that subprime category.
That's right.
So maybe some of that playing out thus far. But I felt like what we've heard from banks thus far, a couple weeks in the earnings season, was pretty darn positive from just sort of the health of consumer.
Yeah, I think that's right. I think overall you can say, and I'm consider myself an optimist, but I am repeatedly surprised about one, the strength of banking, and two, the strength of the consumer. I think this earnings season, what we've seen so far, the banks that have released, most of the major banks, et cetera, better than expected across the board. So I'm pleased. All in all, I think revenue growth at most every bank is up. I think most banks have beat earnings expectations, the publicly traded banks. And I think to your point, it relies a lot on the consumer. Consumer, as you know, and most of our listeners know, 2/3 of the economy. And so how goes the consumer is how goes banking. And even though many banks listening to this are commercial banks, everyone's affected, obviously, either directly or indirectly by the consumer. And like you said, they're spending more than I would expect. There are cracks. So there is cause for concern, but and it is in the lower tier, and I even think in even some of the upper income stratas that there are slowdowns and potential credit problems, but overall still better than average, long-term average, and still doing well. And if you have the growth and you have the credit quality, you're going to do well in banking and the economy. What's your take?
Right.
Give me some of the things that you're seeing.
I think you're right, and I think the surprise comment is a really good one. I mean, one of the things that I think about coming into this quarter is that you had delinquencies on cards, auto, C&I, CRE, so basically everything having risen for 8, 9, 10 quarters in a row, albeit off of historical lows and during the pandemic. And then in Q2, you actually saw almost all of them either stabilize or dip. So you thought, okay, we were going to get a change. Was that an anomaly? We knew there were some interesting things going on in the economy with Liberation Day at the beginning of the quarter, and particularly with seeing weakness in the labor market. It felt like that wouldn't hold up, and it feels like what we've seen is a modest increase in charge-offs, a modest increase or sort of flat in terms of actual delinquencies, and reserves kind of flat. If that none of that lines up as to
That's right.
sky is falling kind of material, and banks are going to put a good face on it, but they're actually not reporting the problems right now. So I agree with the surprise comment that I think it's really stood out. The one thing we did have was a handful of cases that do stick out, and the banks that reported some problems took it on the chin pretty heavily and even caused kind of a sell-off in the regional bank community with loans to non-depository financial institutions.
We've never talked about that before. Like that hasn't come up on any in the earnings season. I think it was Piper that put it in the report. Everyone's talking about it now. Listening to earnings calls, that's mentioned. Let's go through what that is real quick for listeners that may not know what NDFI, loans to non-depository financial institutions, stand for and what it actually means. Because I'm kind of baffled that this is now coming up.
Sure. This is a new breakout that we got for the industry in Q4 and call report data. A lot of banks will downplay it is it's not this odd thing. We've been doing this lending forever. It's just a change in reporting. And to a large degree, that does seem true. What is in that? It's loans to business credit intermediaries, mortgage intermediaries.
Warehousing is a classic one. Yep.
Yep. Consumer credit intermediaries. I mean, a lot of these things could be spec fin or fintech that we've lent to for some time. There is a private equity bucket that we've never gotten that breakout before. And then another loan bucket where there's a whole bunch of stuff in there. And that could be short term financing to hedge funds, repo financing, lending to insurance companies, and federally sponsored enterprises. And we focused on it year to date quite a bit because when you look at overall loan growth, most of it for the industry and dominated by the bigs is coming from this loans to the
Right.
NDFI bucket. So heading into the quarter, I've been having conversations with investors who are going, is this different? They're saying it's not. They're saying it's classification, but some investors who I've talked to for years who make it their job to always say this time is not different and question things. That's just sort of how they approach it. We're kind of questioning the growth here. And I feel like what's an interesting take on this quarter is you saw a handful of banks report some big losses on this stuff. And it was related to either bankruptcies or fraud. But my take on it, I'm curious yours is I don't know that it tells us that it's the canary in coal mine. I feel like it depended on what your view of this was heading in. If you're worried about it and you decide it was a big thing, aha, you grabbed on it. If you thought credit was broadly good and there's one-offs, then the broad results supported that. So I don't know that anybody's opinion really changed that much heading in.
There's always the syndrome that you don't know, is it a canary in the coal mine, or can you just, negate it and just explain it as a one-off? And as an analyst, you never want to say, oh, that was just a one-off, and then it becomes a trend. This one I don't know about, but I think you
Hmm.
call it early on with, I think, the first group of releases when we talked, I don't know, a week ago, or more, when you said, hey, the earnings season so far has something for everyone in it. And this is a great example of that if you think the sky is falling and there's two corporate middle market syndications that went bad, one because of fraud, as you pointed out, and banks took it on the chin, and then every analyst and every major shareholder looked at who had those and hammered bank stocks. So if you look at earnings, I think this is a repeated trend on Wall Street, is that banks are doing fine, and just as they're doing fine and they have record earnings and beating expectations, there's negative sentiment to just hammer PE ratios and stock prices of our banks. And these two credits in particular gave some analysts the negative outlook that they needed to now have that opinion about bank stocks, and we're all getting hammered by it. It's going to be hard to ever prevent that level of fraud. I mean, granted, we can do a better job. We gotten a little complacent as an industry, gotten a little lazy, but if a company is going to commit fraud at scale, it's going to be real hard to catch. And the banking has a history of that going back hundreds of years of that. And so my take is, yeah, we should be cautious. It's not great to have those losses. I think they're well within banks' reserves. So if you look at the phenomenal run, I don't think banks got enough credit for having over reserved and being conservative. And now it's, I think, coming out about, yeah, we've taken a loss. It's long overdue. We're going to have more of these, but it's going to be hopefully within our realm of reserves, and it's not that big a deal overall. So I think that's where I lean, but I am a little cautious.
Sure, and I like the reserve comment. That's a really good one that I think gets missed. And yes, it's driven by CECL, and they're changing our reserve methodology beginning in 20 for the largest banks and a little bit later for smaller banks. But you didn't see reserves really change that much this quarter. And so you go, huh, that obviously means there's no stress, or maybe you worry if even if on your negative side, there isn't enough reserving there. But if you look at where reserves are today
That's
compared
right.
to historical trends, we're really high.
Right.
We're 1.7 for the industry. That's very, very, very high. So part of this is we have built for it. And even if you assume that loss content gets worse and delinquencies get worse, and we do, and I got my name on something this week saying that we think credit continues to slip from here, but the headline was not as bad as some fear. And part of this is because, okay, even if that happens and reserves go higher, they don't have to go that much higher to be at nearly 20-year highs. So that's one of the good things. I mean, we I know we don't like CECL in the banking community,
Yep.
but we're prepared.
Yep, Cecil's done its job. Gets a little harder with that economic data going forward, but yeah, I think we're on the right track overall. And I think most banks, our model, we have a relationship profitability model, and as it predicts out, 1.3 times debt service reserve world. I think we look at maybe things on a 1.5 basis, like you said, banks reserved 1.7. So that's kind of the context of how we see things. And you always look at standard deviations of credit movement. And yeah, I always get asked like, well, how, our bank's properly reserved. I'm like, well, you give me the scenario and I'll let you know more then. And there's always that doomsday scenario where you're two or three, four, five standard deviations out. And yeah, banks are not reserved. But for the most part, for most, 98% of the possibilities out there, I think we're doing okay. So, and I think that's gonna, be the main factor, and everything else is fine tuning. I think this quarter, fees, I think were the big, surprise that everyone did so well on fees, driving revenue at all the large banks, and I think that's a plus. And hopefully, some of that continues with additional volatility.
Wait, what do you feel about loan growth? I mean, this kind of goes back to where we started with the consumer really driving the economy, and good economies, people take more risk. One of the weird dynamics that it feels like we're hearing from corporate America is CEO confidence is really high. You're seeing investment banking backlogs at record levels. That's always an interesting thermometer to me of sort of risk appetite. Am I willing to grow and do deals, not just in the bank space, but everywhere? And you heard that from the Goldmans and the Morgans and stuff. But at the same time, you're not hearing a lot about CapEx, unless, of course, you're a hyperscaler spending on AI. So we feel really good, but we're not necessarily looking to expand that much kind of now. And I felt like loan growth was okay, kind of continuing the same. And you had mixed views on guidance there. Some looking a lot better in 26, and then some kind of missed on that. I don't know. What do you feel like?
Yeah, I think loan growth theme. It's your theme of you can find whatever you want in the number. I think loan growth is, and I talk to borrowers all the time throughout our footprint. And I think the take on the street is, everyone's cautious, but not as cautious as where we were at the end of, first quarter, start of second quarter with the tariffs. People are now getting used to that. Hey, the government shutdown's not helping anything.
Mhm.
The tariff debate is not helping anything. And what I hear is, hey, these borrowers, want to spend. There are trends that I think, some of the smarter borrowers are thinking about. The operating companies are thinking about, like, hey, there's some real changes in the economy given this administration, and you don't want to miss out on that. And whether it's, reshoring is, I think, one trend, like, hey, how can we start to bring more manufacturing back, and do we need more distribution plants and more logistics centers and things like that? So industrial on the CRE side doing well because of that. The immigration, tariffs, government shutdown not helping overall. But I think loan growth, like my overall take on loan growth is there. It could be stronger than I think it could be as much as everyone wants right now. I think there are some banks that are still a little worried about credit and still have tightened things up, and probably rightly so. And so I think that's curtailed loan growth. And you don't know, clearly we're at the back end of the business cycle, whether we're recession 2 years or 5 years. We're due, so everyone's cautious, and you don't want to be that bank that now reaches for that speculative type of deal, and we are seeing plenty of those. I think in banking, I have two or three come across my desk every day on some crackpot financing that is betting on the come and demand, and that you worry about. And I think most banks are fairly disciplined on credit and disciplined on pricing. So I think loan growth isn't the limiting factor. I would say deposits are more of an issue. And with that, your take on loan growth or your take on deposits?
Yeah, I definitely wanted to get into deposits. I think your point there, though, about where we were is an important one. I mean, I heard Brian Moynihan at B of A talk at the ABA National Convention earlier this week. And, he made the point, yeah, we're going sort of high ones, low twos in terms of GDP, but we were a half a point lower than that 3 months ago. And so it's better than the economy's digesting everything better than we thought it would. But I also agree that I continue to say, I don't think we're early cycle, as you just said. It sure feels like we are due at some point, and not suggesting that the sky is falling, you need to expect a recession, but as long as I've been doing this, banks who made money had money when no one else did. You guys are certainly a great example of that coming out of '08, and the growth that you had when people were on sale. So I kind of think that it's okay-ish, but there's enough institutions out there recognizing that the volatility, that concern, the potential for change, probably from keeping it supercharged. Plus, we didn't talk about private credit as much, continuing to still have $160 billion in dry powder they need to put to
Right.
work, which doesn't help us grow our portfolios, and, certainly in the middle market. On the deposit side, it was kind of interesting. I had expected a little bit more declines in cost. I thought growth would be okay-ish. I thought growth would be a little bit lower. It was higher than I thought. I thought we'd be able to drive costs lower, and that would limit growth. What ultimately happened is we paid up a little bit more for growth. Now, we had modest relief, it looks like a 1 basis point, 2 basis point decline in cost of interest-bearing deposits from those that have reported thus far. We were pretty close to that. The rate cut didn't come till very late in the quarter, and we know that the biggest relief from the churn of those highest cost CDs and highest cost deposits rolling off, that we've already benefited a lot from that. But it feels like we are recognizing we want to have this funding, and so we're not gonna be real fast to lower rates, and our weekly rates data kinda supports that. Even in the last few weeks since the cut, you haven't seen huge declines in the incident rate.
But you did see prior to the Fed cut, you did see top rates come down a little bit, right? I mean, the
Oh, you did
sixes,
see
there's some
top, yeah,
sixes
but
out there.
it that like so you've seen the 4.5, the 5s
Right.
go away, and the 4, oh, yeah, and
Right.
even the 4
That's right.
number.
So it was what was four though prior to the Fed cut is now 3.5. So that's some relief. I think we're seeing less competition. But to your point, still overall strong. It's still a nice fight out
Yeah,
there.
yeah.
Depositor by depositor that I think banks are experiencing, and it's still a grind. And customers are still interest rate sensitive, and we're still having to pay up. So deposit growth, I agree with you, better than expected. We had loan growth in 1% on the quarter basis. Deposits, depending on where you look, was either slightly more, slightly less. In my view, slightly less. I think deposit growth was harder to come by. The deposit growth that we did have in the industry, to your point, we had to pay up for. We had to do some exception pricing, get that customer in. But it's getting a little better out there. Less customers, I think, are complaining across the board in banking of the rate. And in this rate cycle, as you and I have talked about, now is the time to focus resources on deposits. It's not loans, it's deposits. When rates drop, this is the time to rework your franchise and rework your offerings in order to be ready for when rates go up. But this is the time to cure the ills that you've done when rates are rising.
Sure, sure, and, that's there's a couple different ways to do that, but probably invest in your franchise to do it. I mean, one other thing we saw is non-interest bearing deposits continue to see a little bit of pressure there. Not a lot, but you would think that we'd be finally stopping that bleeding there to a degree, and we haven't. But what drives that, and we talked about this a lot at the deposit conference that we co-hosted together, in early September.
Good shout out. I like that. Be ready for next year. We're about to
Yeah,
release the date.
great event, by the way, everybody should go. But, it's products, it's not rate. It's don't lead on rate. You had an awesome presentation where you're going through that and thinking about actually how you attract clients in and keep them sticky, and it's not with high cost CD specials.
That's right.
But I feel like I mean, can you talk a little bit about that? Just the idea of, as you said, building your deposit franchise now, because the other thing we talked about there is that that's really what drives valuation, better deposit franchises. So make the case, what are some of the things that work better?
Yeah, sure. When we talk about to get superior deposit performance is not just cost of funds, but sensitivities, balances, sentiment, when it's being clear on what you want to do for the fourth quarter and into 2026 as you do strategic planning. Hopefully, deposits do take center stage. Hopefully, they should be, in your top 10, at least top five, if not your top three, hopefully, but it's being disciplined on pricing. And as you just alluded to, it's doing anything you can but offering rate. Rate is when you throw up your hands before you offer that high yield money market account or do that separate branded digital bank that you've been thinking about. Before you go to that, it's hey, focus on your core products, get creative. Increase marketing. It's amazing to me that we don't market deposits enough. Treasury management, one of the most profitable products in banking, and most banks, really don't spend enough on marketing treasury management product, and they certainly don't spend enough on having a product manager and developing the bells and whistles, and it can be done. Banks are doing it, and you see the number of banks that actually have product innovation or marketing innovation around their deposit products, and it's a small handful. Shout out to Capital One, Chime, SoFi. A couple of these more technology forward banks do a great job. But for the most part, most of us are just clumped in the middle and really don't differentiate the product. And really, we don't really put resources to even think about differentiating our product. And so a bank comes along like Fort Knox Bank spin up, targeting the highly secure, discerning customer that really wants to keep their money safe through any crisis. And I give them credit that that's a way to shift the conversation, a way to price into something that banks can handle, service, trust, security, privacy, etc. So that's the way to do a differentiated product. And it didn't take much, a little creativity, and they're pulling off and attracting the attention. That's my soapbox. Thanks for letting me.
Well, and I love that example, and you have many others, and I've listened to you talk about this before and present on it before. But I feel like one of the messages, and maybe I'm oversimplifying it, but it's try
Yeah,
stuff,
experiment.
try to think outside of the box, experiment.
Yeah, get a
Yeah,
chief deposit
and
officer, get someone like really focused on this, and try whatever you want. And it's dropping rates, on a macro level. It's dropping rates before the Fed. You don't need to be indexed to the Fed. We all sit around waiting for the Fed to cut rates, and then we cut rates. Well, the markets, today, the past week example, rates are already dropped. Everyone's expecting another cut. Why not get some extra time in there? And then, you don't have to go 25 basis points, but maybe 10 basis points in anticipation, maybe 10 the week before
mhm.
and 10 after, and you get 30 basis points instead of 25. And you redo your customer base if you're already at, two and a half, 260 on your cost of funds. This is a way to get it back in line below the average. And that's just on the macro level. And then it's, as you said, the product marketing.
And there's significant profitability pickup when
Huge.
you
And,
do
and,
that
and it
too.
pays off
So
in the future.
it's
Like a less sensitive interest rate
mhm.
today helps for fourth quarter and first quarter of next year, but it also helps 5 years from now when you don't have these rate sensitive customers asking for higher rates across the board.
Yeah, and that's something you and I have talked about too over the last year. I mean, one of the things about this cycle is we've almost trained our customers to think about rate. We've awoken this sleeping giant, the way I talk about it, because there's this huge portion of the adult cohort who never got a rate on their deposits. I mean, think about it from 8 to really 23, if not 24, there was nothing
Yeah,
out there. And so if you're under 40, you don't you haven't
that's
really
right.
seen this for
That's
the
right.
most part. And now it's out there. help reset that thinking for them, and you need to give them service as well too. But if that's all you're curating to, that's what you're going to have going forward.
And more important than your customers are your employees. You teach an employee how to satisfy a customer with rate, and they're not going to learn. They're going to keep coming back, and then you get the problem that if you're a manager, a bank CEO, or a regional president or something, and your relationship managers, your lenders, your deposit, your branch, leads come to you and say, "Hey, we need to pay 3.5% or 4% to keep this customer." You now have to go through this whole big analysis to retrain them to say, hey, it's not really about rate. Have we tried this? And by that time, the battle's already lost. So I always point out like the employees are really the important part. Don't teach them about the service aspect of banking and the product aspect of banking before anything else. And if there's a deficiency there, if you say, well, hey, we can only be so creative, well then that's the problem right there. Let's focus on your technology, architecture, whatever it is that's preventing you to being differentiated in the marketplace. But if you train, if you're sitting at Chime or Nubank, out of Mexico, you're not worried about rate. You're just worried about creativity. What's your next creative idea? And that's what I think US bankers, particularly US community bankers that have the advantage of potentially moving quicker than the big national banks, that's our competitive advantage. And we need to take advantage of that in deposits.
Hmm. You can be nimble. You can be nimble.
Be nimble.
Well,
Yeah.
one last topic in closing here that, and this is kind of picking up on being nimble. Are we feeling like we're going to see more folks be nimble in terms of actually doing some strategic and M&A? And it relates to the deposit conversation because that's really a lot of what you're buying and the value of what you're buying. And we've continued to track that and show that better deposit franchises command higher valuations, not only in the public markets, but certainly through sales. I feel like when you look at the regional group, which the real sea change here is that a lot of those folks were shut out, particularly the 100 plus banks, where billion plus banks were shut out the last 4 years. And now we've seen three of them do deals. I
Yeah.
feel like you kind of heard some mixed emotions there where we're looking, we're not looking. Some people say, yes, we're absolutely looking. I can't tell if they're trying to quiet down. We even had, one large regional who was considered a seller say we're looking, and that
Right.
spooked people to a degree. So it was kind of all over the roadmap. And then throw on top of that, we have an activist who pushed Comerica to sell, now pushing two other smaller
That's right.
banks to sell. So it's there's a lot going on, but I don't know if it's, and I do think we see a lot more deals going forward, but it doesn't feel like it's all flying in one direction right now, at least when you listen to the commentary from the banks that have reported.
Yeah, it's going to be an interesting acquire to be acquired conference coming up in January by my bank director. That's always like my bellwether of what you can tell. And like you said, as I go around, everyone's like saying, "Well, we're not really doing M&A," but they can name every potential acquirer or every potential acquiree. Everyone's looking over their shoulder. You're either looking back over your shoulder or forward over someone else's shoulder, but everyone's thinking about M&A right now. As you pointed out, you now have more activist and investor sentiment going around. So I think that drives it. Everyone has the view that the regulatory environment is we have a little window here. So I think you'll agree we'll see M&A continue to pick up, and it's just a question
Yep.
of where and how you want to play. We've seen, I think, only a tick up, recently in the past couple of weeks of M&A activity, and we'll probably see a bunch more between now and the end of the year. What's your take on that overall?
I think that's right. We've seen a number of deals recently that just sort of feel like normal M&A activity, and we were at such low levels that kind of sticks out to a degree. But we got another one last night
Right.
with Nicolay and Midwest One that stands out as a sizable deal, just shy of a billion. But Nicolay's done 10 deals in 7 years or something like that. So it feels not necessarily that striking. Um, we do have the big guys returning in a way that we hadn't seen, whether that's Fifth Third, PNC, and Huntington. So that changes the landscape. Um, and I think the regulatory environment is far more conducive, and they've talked about that. And so you get faster approval and the ability of larger franchises to look to do things. But I think it's also kind of a slow process, and it takes some time for deals to actually get done. So it isn't, can't just turn on a dime.
You think we should be raising our expectations for fourth quarter or lowering them?
That's tough. Yeah, probably because I think loan yields have held up better, and I think credit, while it scared some people, has held up a little bit better. And ultimately, the outlook we put out this past week did that. We took our credit numbers down, even though they're still going up. We took them down from where we were, and we put our loan yields a little bit higher. And it is kind of what we did. So the margin number was higher, and the required reserve bill was lower. So we did. I'm sure we'll be wrong on some things, but yeah, that I think so.
Will be interesting fourth quarter. I think 2026 will be all about disruption of some sort. So whether it's M&A disruption and you can grab teams or borrowers, or whether it's a merger, opportunity or technology. I think the stable coin tokenized deposit is disruptive in the marketplace. AI is, I think, another one, and I do think like you're going to have this syndrome where more smaller banks are going to throw up their hands and give and almost give up, and that they can't keep up with, whether it's generative AI or ingenic AI using agents, or it's stablecoin or tokenized deposits, that you're going to have to deal with all these major shifts in the industry, along with whatever else the Trump administration has coming for us. Who knows? But I think being nimble through the M&A activity, through the technology activity, will be a hallmark of outperforming management teams next year. So that's my plea to think about how you can have better change management and have better reactions, more experimentation, more autonomy at your decentralized level, whatever it takes to experiment and try to figure out the market. Because I think that's going to be, I think, the differentiator going forward strategically for banks.
hmm and if you're not there, to your point, it's probably just a little bit more earnings pressure and another tailwind for more sellers.
Yep.
Yeah, I totally agree there.
But and we're also, we're loaned up too. So 88%, we're somewhere around there for a loan to value ratio. We need to drive deposits. And I think that's the other one, that if you can figure out how to drive deposits, lower cost deposits with falling rates without getting your margins compressed and being reactive, I think that's another way to drive earnings value. And so hopefully we'll see that, but I think it will be, difficult. So we'll see what happens. But I think we covered a lot. I appreciate you having me on.
Really enjoyed it, Chris. Thanks for going through all of it, and thanks for being with us again.
We'll see you out in the field. Take care.